Gold has been the preferred form of payment throughout history, from the earliest civilizations to the present. Because gold has low correlations to other asset classes today, investors mostly purchase it as a hedge against inflation and political turmoil. In order to reduce total portfolio risk, several renowned investing gurus also advise allocating a portion of your portfolio to commodities, including gold. Welcome to the Money Bender. Subscribe and let's dive in. Gold investments can be made in a variety of ways, such as bullion, mutual funds, futures, mining firms, and jewelry. With few exceptions, the only ways to invest directly in gold are through bullion, futures, and a few specialized funds. The value of other investments comes in part from outside sources. How can I invest in gold the most effectively? Your resources and investing objectives will determine the best gold investment for your portfolio. Gold bullion is an option for larger investors seeking direct exposure, but doing so requires a premium and storage fees. ETFs and mutual funds that track the price of gold provide low-cost exposure with modest investment requirements. However, before purchasing these shares, you should conduct some research because funds differ in terms of their investment philosophies and fee ratios. Purchasing stock in gold mining firms can give investors more exposure to the commodity, but these equities don't necessarily closely mirror gold's long-term performance. How do novice gold investors get started? The simplest and most secure methods for investing in gold are mutual funds and exchange-traded funds (ETFs). You can quickly buy or sell these shares in your brokerage account or retirement account, and each share represents a specific amount of gold. Because they have cheap costs and low minimum investment requirements, gold mutual funds and ETFs are a fantastic option for new investors. Is gold a wise investment in a downturn? Many investors include gold in their portfolios as a hedge against prospective economic downturns due to gold's historically low correlation with other types of investment assets. When bond yields decrease, gold prices typically rise. The effectiveness of gold investments during recessions or any other stages of the economic cycle will rely on how they fit into your entire investment strategy, even though there may be advantages to doing so. Investments in gold have historically been thought of as a buffer against economic downturns due to the precious metal's poor correlation with other kinds of investment assets. The correlation between gold and stock market performance, in instance, has traditionally been minimal, and gold tends to move in the opposite direction from the dollar. This implies that times of dollar weakness may result in higher gold prices. When faced with the probability of a recession, the potential advantages of gold as a hedge against falls in other asset classes may come to the forefront of investors' minds. History shows that gold prices tend to rise in conjunction with falling inflation-adjusted bond yields. Gold jewelry. The demand for gold used in jewelry creation could rise over time as both the global population and affluence are expected to continue to rise. However, gold jewelry customers have been found to be fairly price-sensitive, purchasing less when the price increases quickly. Jewelry production accounts for about 49% of the world's gold output. There is a significant markup when purchasing fine jewelry at retail prices up to 300% or more over the gold's intrinsic value. Estate sales and auctions can have better jewelry deals. The benefit of doing so is that there is no retail markup. The drawback is the time required to look for expensive things. Even while owning gold jewelry is not the most lucrative kind of investment, it nevertheless offers a fun way to acquire gold. Beautiful gold jewelry is a work of art. It is a mediocre investment, unless you are the jeweler. Gold mining companies. A rising gold price will also be beneficial to mining and refining businesses. Compared to other investment strategies, investing in these companies can be a risk-free way to earn from gold. The biggest gold mining firms have significant global operations. Therefore, business characteristics that are typical of many other big businesses contribute to the success of such an investment. As a result, Even when gold prices are stagnant or falling, these businesses can still turn a profit. They accomplish this, for example, by routinely hedging against a decline in gold prices. Others choose not to do this. Even so, investing in gold through gold mining firms might be safer than buying gold bullion outright. The investor must use due diligence in both researching and choosing the specific companies. This is a time-consuming project, so many investors might not find it practical. Gold ETFs and mutual funds. Investing in one of the gold-based exchange-traded funds ETFs provides an alternative to buying gold bullion directly. A predetermined quantity of gold, such as 1/10 of an ounce, is represented by each share of these specialized instruments. Similar to stocks, these funds can be bought or sold in any brokerage account or individual retirement plan IRA. As a result, this strategy is simpler and less expensive than directly holding bars or coins, especially for small investors, as the minimum investment only requires the cost of one share of the ETF. These funds typically have annual average expense ratios of around 0.57%, which is significantly lower than the costs and fees associated with many other investments, including the majority of mutual funds. Investors should be aware that while many mutual funds include gold bullion and gold companies in their standard portfolios, few of them specialize in gold investing. The majority hold a variety of other commodities. Major benefits of gold-only mutual funds include low cost and minimal investment necessary. Among several enterprises, diversification, ownership simplicity in an IRA or brokerage account. Individual company research is not necessary. While some funds are closely correlated to gold prices, others invest in mining company indices. Others still are controlled actively. For further details, consult their prospectuses. Traditional mutual funds have a propensity for active management, whereas ETFs follow a passive index tracking technique and offer lower fee ratios. Mutual funds and ETFs are now typically the simplest and safest ways to invest in gold for the ordinary gold investor. Nonetheless, gold bullion, the most popular type of direct ownership of gold, is possibly this. A lot of people associate gold bullion with the massive gold bars kept at Fort Knox, Kentucky. Actually, gold that has been weighed and its purity verified is considered to be bullion. This includes any form of pure, almost pure gold. This includes gold bars, coins, and other forms of any size. Gold bars frequently have a serial number attached for security reasons as well. Heavy gold bars are striking to see, but because of their great size, they are expensive to buy and sell. After example, you can't exactly saw off the end of a huge gold bar worth $100,000 and sell it if you decide to sell 10% of your entire gold holding. On the other hand, gold owners frequently hold bullion in smaller-sized bars and coins, which offers much more liquidity. Gold coins. The world's sovereign governments have been issuing a significant number of gold coins for many years. Investors often purchase coins from private dealers at a premium of 1% to 5% above the value of the underlying gold, but in certain situations, the premium has increased to as much as 10% in recent years. The benefits of bullion coins include: inconveniently, their pricing can be seen in international financial magazines. Since gold coins are frequently produced in smaller amounts than gold bars, they are a more practical option to invest in gold than the latter. Without much effort, trustworthy dealers may be located in many major cities. The Canadian maple leaf, the American eagle, and the South African krugerrand are a few of the frequently used gold coins. The primary issues with gold bullion are that the dealer's relatively high markup and the fees associated with storage and insurance limit the amount of money that can be made. Additionally, investing in gold directly by purchasing bullion means that the value of one's assets will fluctuate proportionally for every dollar that the price of gold changes. Other gold investments, such as mutual funds, might be made with less money and might not be as directly price exposed as bullion. Larger investors that want a direct connection to the gold price can decide to buy gold directly through bullion. However, there is a small premium added to the original gold purchase price in addition to storage expenses. The prices of futures and options, which are derivatives of gold, can fluctuate sharply. Jewelry is not a good investment because there is a large price difference between most pieces and their gold value. Instead, the typical gold investor should think about investing in gold-focused mutual funds and ETFs, as these instruments offer the simplest and safest method for doing so. Thank you for watching. Follow for more.